Welcome, ladies and gentlemen, to another issue of the Grey Market Talk with Nic the Mr. I. How should I describe you, Nic? I'm trying to up my game every week. I can't make it possibly any more impressive. Let's say a good friend of mine who knows a lot about markets and will give us advice on, obviously this is not investment advice, do your own research, blah, blah, blah. Will give us good thoughts on how markets work. And Thorsten Wegener, a former market maker, which means I couldn't care less whether markets go up and down because I bought the bid and I sold the offer, and that made a lot of fun at the time. But obviously I'm interested what their clients are doing. And that's what we're going to talk about today, Nic. I've prepared a lovely chart deck with interesting things on it. Let me share my screen and let's get right into it. So, Grey Market Talk, 13th of March 2024. I promise you, in a couple of days, somebody will start playing Christmas music in the supermarket. We're not far away this time. So let's start with the S&P. Very interesting what we're seeing here. Yeah, we have new all-time highs. The market seems to be in a very stable condition, and I've got a fantastic LinkedIn post by James Bianco, and I thought that actually sums up in which stage we are in the market. Let me read to everybody who's just listening to it. My new favorite ETF, says Jim Bianco, after his obviously, is symbol quadruple X, 4 times leveraged S&P 500. It started trading on December the 5th. Buy it on a margin account and get 8 times leverage. And then he closes with, I can't wait until they list options on it. Yeah, pretty much sounds like a plan to me. And all of us who have their heads still screwed on, see what's going on. And, well, we are cautious here. So let's go into the economy where I can pick your brain. The economic data coming in. This is a slide from Game of Trades. Fantastic slides they're always posting in their little shows. Goes into the median home prices, and that looks disastrous to me. Median home prices sharply contracting. So obviously, that's the reason that people are not buying at current levels, and they're also not selling at current levels. Does that mean the market is just frozen for a time being, and when things normalize, we're back to good? Or does it mean the market is in for a huge crash if interest rates stay at that level, Nic?
Well, I don't think it's an interest rate thing. Yeah. So we talked about this numerous times, that, what effect does interest rates have on the economy? In certain sectors are not doing well. Obviously, if you're buying a house on leverage, and most people do when they take a mortgage, it's more expensive. But arguably, when the economy grows, so do interest rates go up. So interest rates just follow nominal GDP. And we are where we are. But a few leverage, sectors like perhaps private equity, commercial real estate, they're obviously suffering a bit.
I was trying to lure you in a trap here, because the next slide is obviously delinquency rates of multi-family housing, which is, can we describe that as the middle class? It's not the affluent single somewhere in a box in San Francisco. It's family guys.
Yeah, I don't know where this thing fits in, whether this also comes into the bucket of commercial real estate. I think it probably does. But bottom line is, as I say, certain sectors don't like high interest rates, but that's not the whole economy.
Well, I really don't know how to interpret this whole thing, Nic. It's on the one side, you see numbers that the biggest asset everybody's ever going to buy, if you don't buy a super yacht. But even then they have houses that are more expensive. No, not really. Anyway, so let's assume we're not buying super yachts. The biggest investments you can possibly do as a private individual is the house you're living in, right?
Yeah, absolutely. Absolutely. But, the question is this systemic, and is this enough to pull the whole economy down? And, question mark there.
Well, haven't we seen that in 2008?
We certainly did. But if I look at your chart, the delinquency rates actually didn't rise until after the crash. You have a look there.
Maybe markets are a bit smarter this time.
I don't know. I don't know. I think there's an awful lot of data which makes the economy look absolutely trash. There's also an awful lot of data that says the economy is in okay shape. And you have to decide, do you follow economic data, which is kind of backward looking? And we spoke about this from probably the very first video when we said, well, okay, what is driving markets today? And we talked about the DAX last week. We said, well, what the hell is the DAX doing up here with the German economy in the state that it's in? And a year ago, we spoke about, is there enough liquidity in the system in order to continue to roll debt? Is the answer yes or no? And at the time, the answer was yes. And it seems, according to the data that's coming out, that liquidity continues to grow. And that is economy supportive. The question is, are the financial markets moving a little bit too far ahead of themselves? And that's where I'd say tactically, this isn't necessarily a clever place to buy it, even though the underlying effects of liquidity suggest that, the economy perhaps will be in good shape over time. And perhaps all of these things we're looking at are confusing.
I have a couple of charts on liquidity coming, which are also contradictory. Let's go further, because if we markets, I've called it, are we there yet? And that's another question I have. I get these charts, dumb money versus smart money. How do they classify that, Nic? What's dumb money? What is smart money?
I think this is classified between institutional investors, which is supposed to be smart money, and retail investors. And
you mean the 80% who never beat the index, yeah? They are the smart money.
Well, I've got a comment on that, and you're right when you say that, because I might have mentioned it before. I attended a conference, one of the global sort of credit rating agencies, that exist, and the chief economist there, basically, and this is January, right? January first week, he said, well, we have changed our view mid-December on the economy, and we're no longer looking for a recession. Now, imagine the stock market's gone from 3,500 at that stage to, 4.8, 4.9. And we are telling our clients now that we're bullish. Now, I was thinking, well, the stock market's gone up effectively almost 1,500 points. That's 50% almost. And you're now saying to your clients, get in. So institutional money is sort of saying, oh, we now have authorization, kind of the support to go and go and buy stuff. I think you're right that some of the smart money these days, not so smart. If we look back last year, a majority of Wall Street, majority of advisors were all saying recession, S&P below 3,000, don't buy it. And at the end of the year, the majority of them changed their mind. And now everyone who's buying is theoretically smart. I'd say, well, if you didn't buy it down there, if you didn't like it down there, don't buy it up here.
Yeah, because for me, it's like all the guys, everybody sneers on and snickers, they're the odd lot traders. They made a hell lot of money with their buying calls in 0 days to expiration option, just taking the money off the table. However, what I do believe in is money flows. And that's what I found quite interesting, actually, is money flowing out of the techs. And we've seen it last week. We discussed that before in the green room. We all know that NVIDIA can't keep up with these growth rates, at least not in the medium to long term. Eventually, competition will come in, input costs get higher, their margins will not deteriorate to zero, but they will come under pressure. And then we see this one-day intraday reversal when it make from peak to low, minus 10% on the huge volume. And I was looking at the chart and thought, is that what people nowadays want to see? They want to see a single candle chart pattern to confirm what the fundamental data, the cautious guys like myself, are preaching all along. Is that how markets nowadays work? And when you look at the flows, if this chart is correct, then we see coming money big time out of the tech market. Could that be an indication? We started with the Magnificent Seven. Now we're down to 4, right?
Yeah, I mean, you know, my view on that is it's pretty similar to what I just talked about, where smart money is now coming in at the top of the market, or, you know, what I think is very close to a top end market. You know, I think smart money, if that's the case, then the smart money are those people who are probably, you know, causing this strong outflow because they've been long all of this time, and you know, they're selling into a Microsoft strength or an Apple strength. We spoke about Apple last year. We said, look, 3 trillion company. If somebody said to me it's worth only 2 trillion, in other words, the stock goes down to around 120, 130 instead of 190 it was, it wouldn't surprise me at all. And, you know, what would I do? I'd sell Apple and go and buy some small cap. And this is, you know, actually that trade has worked really quite nicely. The small caps have done a lot better than Apple. But yeah, I mean, you know, it doesn't surprise me to see some people taking money off the table up here.
I find it quite interesting. Money seems to have lost all meaning. Yeah? A trillion here, a trillion there. Who knows? Yeah, it's like this. I remember when I was a young lad, where if you were a millionaire, yeah, a simple millionaire, you wouldn't have to work for the rest of your life. Now being a millionaire is almost like in the olden days when you were a millionaire in lira, Italian lira. Yeah? Fine, it didn't really matter, but that was actually a good segue. I wanted to talk
about that thought, indeed.
I wanted to talk about monies, yeah, real money. And you mentioned liquidity earlier. Excess household savings. Yeah, somewhere this money has to come from to find its way into the market. Yes, we know they can print it, and there's money apparently on the sidelines which is coming in, but we still have a high interest rate environment. So all these people who are not buying houses at the moment, are they going into the stock market, Nick? Because the chart we have here is the spending boom fueled by big savings is over, allegedly, according again to Game of Trades. Household excess savings as share of GDP are now negative. What we are preaching for a while now. Yeah, they're unsaving. People are blowing out everything and play with their credit cards to contain their living in this high, well, tail end of the high inflation environment, because people say, oh yeah, inflation is coming down. In real terms, everybody got over the last 3 years a pay cut of a quarter of their check they have, and salaries haven't made up for that. So is that pinching the hose eventually?
So I am, you know, not just, I think we are at a kind of an important point in the stock market, but in fact, last week you showed also a chart, something similar about retail spending, which I thought was very interesting.
Go more further, the bank credits in here as well. They confirm.
And I thought that was extremely interesting, especially because the US is a you know, consumer led growth. And if the consumer is tapped out, then obviously that's a really important thing. And he's not tapped out because interest rates are higher. He's tapped out because he's gone to spend everything, right? So, I mean, that's the reality. So I am a little bit cautious about the economy. I'm not saying that at the moment there are clear signs that you know, the economy is heading into a recession, but I don't think it's a one-way bet anymore. And there are clear signs that there are some headwinds coming along. And that's kind of going to be a fascinating thing for the FOMC for the Fed to decide how they want to deal with that. You know, do they want to?
I know how they're going to do. How they're going to deal with that. Next chart is, I call it burn, baby, burn. Time required to reach total US debt levels. For the first 10 trillion, it took 230 years. To 20 trillion, it took 9 years. To 30, it took 5 years. And the last trillion, 100 days. So latest level at 34.4 trillion US dollar. Looking at that, then we come to the M2 money supply. Again, thank you, Game of Trades, for this beautiful chart. They whittled it down to the Great Depression. So it goes back a full 100 years, we see here on the chart. And as they put it on the chart, is that M2, which is, well, money people actually can really spend, right? Is at the lowest or at low levels like we've seen at the Great Depression. The question is, you brought that in earlier. When did that happen? While we were in the Great Depression or before we went into the Great Depression? I think it happened while we were in the Great Depression.
So, you know, I've looked at this. Firstly, M2, I think if you look at the latest data, it's slightly turning higher. So it's a I don't know when the data is valid on this thing. It says total. Okay, this is valid till October 23.
November 23.
The point is, I think that they're trying to make is that, money supply was expanded. Money supply is responsible for inflation. So money supply grew at something close to 30% in the States. And, from what I said in previous videos, the money supply gets used up by growth, real growth, and by inflation. So nominal GDP eats up the money supply. And of course, because we're coming from a very, very high growth period, the rate of change of money supply, if you don't expand the money supply, is going to look awful. And of course, with a bit of quantitative tightening, suddenly you see negative money supply that, has only existed sort of 1930s, depression, great crash, and all of this stuff, and it sort of all looks horrible. But when I looked at the money supply numbers, there is still money that needs. So in other words, although the rate of change is falling, there is still a little bit, not a great deal, of money still in the system that will avoid, the great crash. And I think that's important to look at. And obviously, it is a very important thing. But I think this chart probably doesn't tell the whole story. That yes, the rate of change is negative, but there is still an awful lot of money, in my view, still in the system. But it's close to being eaten up. I don't think it's been fully eaten up by growth and inflation. But we are very, very close. And that, again, comes back to, what does the Fed want to do with bank reserves? Do they want to keep them ample and rising, or do they not? And that's an important question. But, the chart looks horrendous. But in my view, if you'd have looked at the chart a year ago, you'd have seen this, and you wouldn't be long of anything. And
two things.
Look at the volume rather than rate of change. Sorry.
First of all, we shouldn't call it money supply anymore. We should call it currency supply, right? That makes more sense. Because if we're talking about real money, you ask what the Fed's doing with their money. I know what they're doing. I've just put up the gold chart here, like all central banks in the world seem to do at the moment. They are buying gold. Yeah? And just to give a reminder, another beautiful slide I had, somebody compared 1920s, a gold bar. You could buy a family home for $5,000 equivalent. That was one gold bar. And now you can actually also buy a medium family house in 2023 for 250 of these gold bars. Well, in the past, 250 of the gold bars when gold was trading at 30. So it's a fantastic store of value we still have here in gold. And that brings me to the central bank point, which I found very interesting. We mentioned this chart briefly before. Apparently, it's making the rounds at the moment. In global central banks, gold holdings as percentage of foreign reserves. And this looks actually still quite subdued. There is a lot of space left till we've reached levels of the 70s and 80s here. At the moment, we are, what is that, roughly 20%? 70s, 80s, we had it between 65 and 80% almost. Is there a trend here, Nick?
So, yeah, I mean, again, I think in the very first video or second video, I spoke about sort of gold and Bitcoin as being the necessary pieces of a portfolio that, was driven by the fact that debt is just so horrendously high and not coming down. And the only way that governments can continue to have such debt is if they print more money, and if they're supported by their central bank, so the the Fed, printing more money. So they're debasing your currency. They will continue to debase your currency, and that is why Bitcoin and gold are important pieces of your portfolio. These are, the monetary hedges that are required. And if you look, more and more regularly from the US, you get these budget forecasts, 10-year forecasts. They're not going down; they're going up. And politicians have absolutely no interest in doing anything about it. So whether it's Republican or whether it's Democrat, their intention is continue to spend. If they continue to spend, they need to finance themselves. Who's going to finance them? Well, they're going to firstly find a way for banks to finance them without probably counting treasuries in their, capital to reduce their capital. The second thing is they're almost certainly going to participate by printing more money and increasing their balance sheets. And I think that is why you see gold and Bitcoin absolutely not follow when real rates started to rise from negative to positive. Bitcoin and gold just didn't collapse, and in particular didn't collapse.
That's a difference here. We just spoke about gold as a store of value, and fine, it is in line with inflation. It saved your money up, but on long term, you could say there's never really an outperformance of gold. So the question, first of all, if this is now sustainable, this breakout we've seen in gold, where does it go? And you just mentioned it, my new favorite topic I know nothing about. Does Bitcoin? And just to piss everybody off, I love to use logarithmic charts because then it doesn't look that dramatic. We are now at levels of 72,000 here on the chart. I just pulled it up before we started this conversation. What's happening with Bitcoin, Nic? Is that sustainable? Do you see a leg up there, or are we going to suffer through the high volatility again to eventually end up with a real money alternative?
You still hear from people who haven't participated at all in a Bitcoin rally say, well, there's nothing to do, there's nothing backing this thing. What do you want to buy Bitcoin for? It's worthless. It'll converge to zero in the end. And, the answer to that is really, well, that assumes, therefore, that there's zero utility in Bitcoin. In other words, you can't use it to do anything. Now, the question is value. What price? Why would you pay $70,000 for this thing? Previously, you had a chance to buy this thing at $10,000 or $20,000 or $30,000. Why are people buying this thing for such money? Obviously, people must see that there is more utility in this thing.
Is that really? Sorry, let me disagree with you. Do you think they really see utility in this thing, or they're buying it because it could double in the next month?
Well, okay.
Because there are two completely different motivation here. Yeah,
absolutely.
In gold, I can see the utility.
I agree. So fair point. So here's a tulip. You remember the tulip mania?
Oh yes, I'm not that old.
Well, you weren't there, obviously. So the tulip mania. Go and buy a tulip. Price goes up, I don't know, let's just say 100 times, 1,000 times. And at the end of the day, if after 1,000 times it's gone up, you look and it's still a tulip, well, that's going to zero, and for sure. So if you're buying Bitcoin, you're paying 70,000 for this thing, and you look at this thing after it's gone up from 30,000 to 70,000, and you say, is there any value in it? Can I do anything with this thing other than just, I bought it low and I'm hopefully going to sell it higher? And I think the answer to that is you could do a damn sight more with your Bitcoin than you can with a tulip. And, what can you do with it? And make payments, store value and all of this stuff. It's the same thing with gold. What value is gold? It's a lump of metal. It sits in the corner of a room. It looks very pretty. It's shiny. It doesn't pay you dividends. What does gold do? And I think both of these instruments are alternative forms, and they are a signal to those politicians, to central bankers who have devalued and continue to devalue your money. You said it earlier. If you had £1 million, 20 years ago, you were well-to-do, you were super rich, you could retire. Now you have £1 million, you still probably have more debts, you're struggling, house prices have gone up. What can I do? Buy a car, it's another 50,000 gone. Money quickly goes. And this is all because every single year, governments from not just the West, but all over the world, continue to print and devalue your money. So you need to find something which will hold its value. There's utility in a house. You could live there. You could rent it. People say, well, okay, I need something monetary. I need something else that I can have as a store of value. and one of them is gold, because that's had a 3,000-year history. I'm pretty sure that's going to hold its value. And now there is something called digital gold, Bitcoin.
Well, I know what Bitcoin actually does. Yeah. It's a great supplier of demand for energy. I came across this very, very interesting chart. It says the Bitcoin energy value from Capriol Investments, created with DataWeb. We spoke about that briefly beforehand, and I've never seen it before. You've never seen it before. They said, okay, fine. It's a chart. The correlation is obvious, right in your face. Energy value goes up, and Bitcoin goes up. Question that came straight to me, they described it as the intrinsic value of Bitcoin as priced by raw joules of electricity into the mining network only. So yeah, by pure energy, but shouldn't we bring prices, market prices for energy in there somewhere in a chart like this?
I'm sure. It's a great sort of, give this to a student and say, go and analyze this thing. And I'm sure there's a lot of things that you can write about, and explore this thing much further and come up with a value for Bitcoin, and that might make a lot of sense. I mean, I've seen these stocked flow charts, and there isn't an answer to say, well, what is the final value for this thing? Nobody bloody knows. But the point is, I think whilst governments continue to extend their borrowing, their debts, and have absolutely no interest in reducing their debts. Question: do we really want that anyway? Things like Bitcoin seem to do very well, and good luck to everyone who has this stuff. We've talked about it. It's an important part of the portfolio. Where's the point? Do you sell? Don't know is the answer. Cyclically, so there are cycles, and there was some work done by the Foundation for the Study of Cycles, if anyone wants to follow them, Lars von Tienen, German, who basically analyzed the cyclical situation on Bitcoin. Talks about a 200-day cycle, and there's 5 cycles up, 5 cycles down on a 200-day pattern. We are in, I think, the third wave or the third cycle of 5 up. Likely to peak in 2025, if you believe in the cycle pattern. So, there is some history supporting that, and that's also an interesting study as to timing the high in Bitcoin rather than providing a price for the high in Bitcoin, because I just don't know.
No, I find it actually quite interesting. It would be a fantastic target for the green zealots to look at this and say, wait a second. Bitcoin now has this energy consumption, which is growing exponentially, as we see here on the chart. Wouldn't that also mean, hey, let's switch off Bitcoin or stop the mining? Well, then Bitcoin would go through the roof, right? If we stop the mining. Or just let's forbid it because it uses too much of our valuable energy, which cannot be created by solar panels or windmills or turbines.
Well, the answer to that is, firstly, again, it comes down to utility. But Amazon, I read recently that they are now plugging their Amazon Web Service to a nuclear power plant. They have such demand for energy. And think about it, all of this AI, that's going to need energy. What, you're not going to use it because it uses energy? But Amazon have plugged themselves into their own nuclear power plant. And, that may well be the future where these large industries or these heavy users of energy find, how should we say, green solutions to powering their business, and nuclear is green.
Well, I read about that as well, about the data centers, and then the main concern was reliability of energy, because the brownout is just around the corner if you are not directly connected to a nice nuclear power plant. So you might have trouble. Yep.
It's cloudy where I am right now. That means solar panel isn't going to help me. So we all need energy. And if you're an industry, you need to have a secure source of energy. And obviously, Amazon cleverly have found a good way to do that.
So let's sum that up, because I want to come to volatility. So gold is cool, Bitcoin is cool, markets are cool, liquidity is not of concern. So let's mortgage up the house, Nick, and go long again, yeah?
Well, there you go. There you have it.
I give you another confirming factor, actually. Obviously, I always have sentiment. I have the fear and greed index in there. Nothing new here. We're still in greedy territory.
Really?
A year ago, we were.
We're not even in extreme greed. That's phenomenal.
No, we've been in extreme greed last week. Obviously, this Nvidia punch on Friday took it down a little bit, because people are not starting to question the AI story, but you hear more and more people thinking about it. We're not quite there yet, but it's always interesting. Extreme fear was after the market took a year ago, took a huge dive. We were at 23, and now we are still in territory of extreme greed. But another confirming factor for going long and being rich, I have a chart of the VIX here. And that is very interesting. VIX is still at subdued levels. We always are at the low around 12, 13 here. And the big question is, where's that actually coming from? This is the volatility of the VIX itself. Stuff people like my good self are trading. We look at the volatility of the VIX. You can price options on that, and that's being traded also at very low levels, which means there's a lot of supply coming into the market. And there was an interesting article, I think it was Financial Times, that the Bank of International Settlements came up with a solution for that. They said, we see an enormous demand for structured products in the market at the moment. And these structured products is yield enhancement. It's basically writing covered calls. So investors are sitting on a lot of investments. They sell calls on top of it. Banks are structuring that. So they are buying the volatility. They're buying the calls. As a market maker, I'm not price sensitive. I get stuff booked in by my sales guys out there. They're saying, oh yeah, we sold another trillion of this beautiful product here. So you're buying volatility. So I buy volatility at levels hopefully below the market, and I'm immediately turning around and dump it. And I keep dumping it as long as these guys are buying it. I'm not their risk manager. I'm not warehousing their risk. I get it in, I sell it. And that brings the VIX under this pressure, as we are in a market situation where actually you should trade much higher. And I found that a very intriguing explanation. What it also started ringing my alarm bells. Do you know when I did see that the last time at that magnitude? Or twice.
My guess is when you were at Bear Stearns.
2008 and 2000, when we started with that rubbish.
Right.
We made an absolute killing with yield enhancement, and 2008, obviously, just the same. Now, and I didn't look too much into the data. Obviously, the Financial Times wouldn't write it if it's not true. They were both based on a study of the Bank for International Settlements. And I thought, ooh, that is actually quite an interesting point to say, yeah, now I've got an explanation why this stuff, why volatility is at levels which I think it shouldn't be, not in a market situation like that, which obviously if you twist it around or turn it around by 180 degrees, if something happens, well, then we see a spike to the upside, especially that half of the market in longer or medium-term volatility has disappeared. They're now all trading 0 days to expiration options. They will be wiped out on day one. And then you miss a whole or 50% of the marketplace who used to provide liquidity in medium to longer term volatility. They are just not there then anymore. And then you see these huge spike when we have the catalyst that it eventually will happen. So that's my 5 cent of thoughts on the whole volatility complex here. However, if the market is at levels in vol where we are at the moment, it's the levels I like to buy. Even if it's only short-term trades, we always see these little spikes going up a little bit. Well, we can still make decent money out of it, and you sleep very well, actually. Oh, no. I've just stopped my presentation. Bloody hell. Can you still see, or do I have to reshare?
I can see you only.
Share screen. God, resharing it. That was the Wrong presentation. Here, going back to the VIX again, yeah? We are again at these levels, and especially if we still have the recession fears in here. When did we see the spikes? Leading up to recession, or at least when we came into the recession? Now is the question, is a recession sooner or later imminent? Yes, of course. There will always be recessions. It will always come one in. Yeah? Question is, how long will it take? And are these levels of 12, 13 in the VIX actually to be undercut at single-digit volatility? I'm not seeing it. I think these are still very, very excellent levels to load up on an asset class, which eventually, well, let you sleep well and could bring you huge returns.
It's, I think it's a very difficult investment climate. I think, this is much more suited to trading than investing right now.
Eventually, the supply in structured products will also wane away. Seen that. They come in cycles, they go in cycles. Anyway, let's close on the absurdity of the week. Has nothing to do with markets, just with the state of the society. A very good friend of mine has moved places in the UK, and she had to register at a new GP. And that is what she had to fill out. Data Protection Act, she had to tick the boxes, whether she was white Cornish, white English, white Irish, white Scottish, white Welsh, other white background, Africa, mixed white and black African, Caribbean, mixed white and black Caribbean, other black backgrounds, Bangladeshi or British Bangladeshi, Indian or British Indian, Pakistani or British Pakistani, other Asian background, Chinese, Gypsy Roman, traveler of Irish heritage, any other ethnic group enter here. So her husband opted for Jedi, which I think is a valid option. Nick, have we gone completely crazy? We used to be Brits, we used to be Germans, we used to be Americans. Now you want to register for a doctor and they do everything. Sorry, I have to call them racists to racialize bloody everything. It's unbelievable.
Obviously, firstly, I agree with you, but you've got to think that probably the local authority or the government have paid some consultant hundreds of thousands to come up with this thing in its current form. The way of the world is all I can say.
Would you feel included or singled out with something like that? I would feel singled out. It's ridiculous.
Well, they want to know more about you, is all I can say. Best you get some private money.
That you want to know more about you. I have another story. American Express is not a bank in Germany. Yeah, they've lost their banking license, but they still fall under the money laundering and compliance rules. So now you probably have that as well. They're updating their data. And suddenly you have to answer all these weird questions. And one of the questions is also how much money you make in a year. And I thought, oh, good people from American Express. I always thought that is something between my tax authorities and myself. Why do you want it now? And nope, it's part they have to do it. So I thought, yeah, we are really getting into a state. They want to know if you're, I don't know, Bangladeshi, British, Jedi, and they want to know how much you earn. And then we have soon artificial intelligence, which doesn't seem too intelligent, coming around the corner. We're entering a weird world here. Bringing it back to volatility, I think volatility is far too low. What's ahead of us, Nick?
Yeah, well, that's a fair point, and we're not in a stable world. That's for sure.
Yep, can say that. Any famous last words before I have a look at the markets now? They've changed the time again in the United States.
Absolutely, I think the market's already open for an hour. No final words. Bitcoin and gold, I guess, is the final word.
I take you on the gold anytime. Yeah, I can still play with it. It's shiny, as you said. It's golden. It's lovely. With the Bitcoins, I'm not quite there yet. It's for me, actually, the fascination with Bitcoin is you ask for utility. Isn't the biggest utility is to stick it to the man? Reminds me of GameStop or AMC. It's this, yeah, you play around with what you call money, which is basically only currency, and you print it and manipulate it and do whatever with it. So, no, I'm not playing your game. I'm having some Bitcoin.
It is legal tender in El Salvador, if that helps.
So if we're ever going to move to El Salvador,
There you go. That's your downside.
I'll consider the purchase
That's
of
your downside. If
of
you
a Bitcoin.
if it goes to zero here, then you can go and use it over there.
Lovely. Thank you very much for your time, Nic. Thank you very much for watching us. If you like that, subscribe, like, and share, and leave a comment. See you next week. Bye-bye.
See you. Bye-bye.